Brad Williams, Frugal Finance. Fixed and floating loan rates. In recent years, interest rates have fluctuated dramatically. Fluctuation rates generate interest rate risk that few economic agents are anxious to bear. For example, in housing finance, home buyers seek fixed rate loans because fixed rates protect the borrower against rising interest rates. By the same token, lenders may be unwilling to offer fixed rate loans because they fear that their cost of funds might rise. With fixed rate lending and a rising cost of funds, the lender faces a risk of paying more to acquire funds that is earning on its fixed rate lending. Therefore, many lenders want to make floating rate loans. This problem continues over and over and over and over. This information, well, it's old. It was well before the 2002 financial crisis. It happened again in 2022, or was it 23, where Silicon Bank went upside down and a number of other banks went upside down for the exact same reason. Managers just don't get it. They don't understand duration, period. Financial managers, they just go about doing their day-to-day stuff, making way too much money until a crisis arises, and then they go, oops. And by that time, it's, oops, you're out of business. With that being said, in this section, we show how the borrower who receives a floating rate loan can effectively convert this loan into a fixed rate loan, thereby protecting against rises in interest rates. Similarly, for a lender who feels compelled to offer fixed rate loans, we show how the lender can use the futures market to make the investment perform like a floating rate loan. Either the borrower or lender can bear the interest rate risk. Whichever party bears the interest rate risk can hedge the risk through futures market. In a floating rate loan, the borrower bears or hedges the risk. In a fixed rate loan, the lender bears or hedges the risk. Someone accepts it and one takes it. This is nothing new, considering that this information is dated and probably before the swaps market, and maybe swaps market kind of ingrained this information. Essentially, that's all we're doing is we're swapping one for the other. This strategy may be dated. It precedes swaps. Why? Because futures markets have been around since what? I don't know, time. People have always been negotiating forwards, and agriculture was the basis for the commodities market. And subsequently, finance and agriculture probably match one another, and hence this format has been around well before swaps. But that being said, what you want to do is understand this. So when we step into the swaps arena, you're going to go, all right, all we're doing is switching futures for swaps. The reason swaps are so popular is cost and the flexibility of the swap market. Generally, when there's a new product, it's price driven and efficiency. While the futures market growth has shrunk, it's been replaced by the swaps market. And then I'm sure something else will be created that will override the popularity of both. I'm going to get into converting a floating rate loan to a fixed rate loan. A construction firm plans a project that will take 6 months to complete at a cost of $100 million. The bank offers to provide the funds for 6 months at a simple interest rate that is 200 basis points above the 90-day SOFR rate. Not a big deal. However, the bank insists that the loan rate for a second quarter will be 200 basis points above the 90-day SOFR rate that will prevail at that date. The bank's getting greedy. This is where other tools come in. For example, swaps. Also, the construction company must pay interest after the first quarter. Principal plus interest are due in 6 months. Well, that's generally not the case, but in this example, let's just say that's the contractual requirement. Today is September 20, and the current 90-day SOFR rate is 7%. December futures yield is 7.3%. Based on these rates in the borrowing plan, the construction company will pay 9%, 90-day SOFR at 7% plus 2 for the first 3 months and 9.3% for the second 3 months. These rates give the following cash flow from the loan. So receive principal $100 million, pay interest $2.25 million, pay interest and principal $1.2. Again, this is not realistic. If it's a construction company, you take draws. But if we did that, it would take forever to explain this. But let's just say they received the $100 million all at once, and now they're going to be sacked with significant interest. So now they have to pay interest and principal of $102. A $100 million project being completed in 6 months? Look, you just go with this example, all right? Because these are the questions you're going to ask. Well, this doesn't make any sense. It is only an example. Don't comment saying this is not realistic. Well, it's not realistic. It's just an example. So you can extend this, all right? You can say it's a 5-year project and you can take draws. You can create anything you want. Do whatever works for you in order to figure out this hypothetical. The cash flows for September and December are certain. However, the cash flow in March depends upon the SOFR rate that prevails in December. The firm expects 9.3% rate, which equals the futures yield for the December futures plus 200 basis points. However, between September and December, that rate could rise. For example, if the spot 90-day SOFR rate is in December is 7.8%, the firm will pay 9.8%, and the total interest due in March will be $125,000 higher than expected. The construction firm decides to lock into the 7.3% futures yield and is expected 9.3% borrowing rate, so that it will know its borrowing costs. Starting with a floating rate loan and transacting to fix the interest rate is called a synthetic fixed rate loan. Table 612 shows how the construction company trades to protect itself from a jump in rates. At the outset, the firm accepts the floating rate scheme for its loan and sells 100 December Euro-dollar futures. If rates rise, the short futures position will give enough profits to pay the additional interest expense on the second quarter's loan. Table 612 shows the SOFR rises by 50 basis points to 7.8%. This implies a borrowing rate of 9.8% for the second quarter, as the table shows. However, the rise in rates has created a futures profit of 125 grand, 50 basis points times 25 per basis point times 100. The table shows that the firm pays $125,000 more interest in the second quarter than anticipated due to the jump in rates. However, this is exactly offset by the futures profit. In September, the firm expected to pay a total of $4.75 million in interest for the loan. Counting the futures profit, that is exactly the interest the firm pays because it hedged. By trading in the futures market, the construction firm changed its floating rate loan into a fixed rate loan. I'm going to say this is going to be 2.5. I'm changing this. Converting a fixed rate loan to a floating rate loan, we now consider the same transaction from the lender's point of view. If the construction company really wants a fixed rate loan, let them have it. Reasons of the bank. We assume that the bank's cost of funds equals the 90-day SOFR rate. Cost of funds. The bank expects to pay 7% for funds this quarter and 7.3% next quarter, or an average rate of 7.15% over the 6 months of the loan. Therefore, the bank decides to make a fixed rate 6-month loan construction company at 9.15%. The bank expected profit is a 200 basis point spread between the lending rate and the bank's SOFR-based cost of funds. The bank expects to secure the funds by borrowing. The construction company is worried about higher interest rates, keeping in mind lower SOFR price equals higher SOFR rates. The construction company will sell SOFR future contracts to hedge against higher rates. Synthetic fixed rate borrowing, cash market. September 20, borrow $100 million at 9% for 3 months and commit to extend the loan for 3 additional months at a rate of 200 basis points above the 3-month SOFR rate at the prevailing time. Sell 100 December Euro-dollar future contracts at 92.70, reflecting the 7.3 yield. December 20, pay interest of $2.25 million. SOFR is now at 7.8, so borrow $100 million for 3 months at 9.8%. Offset 100 December Euro-dollar futures at 9.2%, reflecting the 7.8% yield, produces a profit of $125,000 equals 40 basis points times 25 per point times 100 contracts. Pay interest of $2.45 million and repay principal of $100 million. Futures profit $125,000. Net interest expense after hedging $4,575. I'd have to double check that, but just go with it. For these 4 quarters, the firm expects to finance the $100 million at 9%, 9.3, 9.6, and 9%, respectively. Therefore, the construction company expects to borrow $100 million for a year at an average rate of 9.45%. This gives a total expected interest cost of $9.45 million. September 30, borrow principal $100 million, make loan to construction company, pay interest, receive principal and interest from construction company, pay principal and interest. If all goes as expected, the bank's gross profit will be $1 million. Having made a fixed rate loan, however, the bank is at risk of rising interest rates. For example, if SOFR rises by 50 basis points to 7.8% for the second quarter, the bank will have to pay an additional $125,000 in interest. To avoid this risk, the bank transacts as shown in 613. Notice how they have almost exactly matched the transaction of the construction company, except that the bank has lower borrowing rate. If interest rates rise, the bank's cost of funds rise, just as was the case for the construction company with a floating rate loan. Both the construction company and the bank were able to hedge by selling euro-dollar futures. With the rise in rates, the bank paid $125,000 more interest than expected. However, this increased interest was offset by futures market gains. Originally, the bank wanted to shift the interest rate risk to the construction company. However, as the transaction 613 shows, the bank is able to give the construction company the fixed rate loan it desires and still avoid the interest rate risk. In essence, the bank creates a synthetic floating rate loan. For its customer, it offers a fixed rate loan, but the bank transacts in the futures market to make the transaction equivalent to having given a floating rate loan. Strip and stack hedges, I touched on this earlier. Why don't we revisit this? In the example of the synthetic fixed rate loan and synthetic floating rate lending, the interest rate risk focused on a single date. Often, the period of the loan covers a number of different dates at which the rate might be reset. For example, a construction company of our previous example makes a more realistic assessment of how long it will take to complete a project. Instead of 6 months, the construction firm realizes that the project will take a year. The bank insists on making a floating rate loan for 3 months at a rate that is 200 basis points above SOFR, prevailing at the time of the loan. On September 15th, the construction company observes the following rates. 3 months SOFR 7%, December, March, June. The lender's worried about the higher interest rates, keeping in mind higher SOFR prices equals lower SOFR rates. The lender will buy SOFR future contracts to hedge against lower interest rates. Here we have September 20, borrow $100 million at 7% for 3 months and lend for 6 months at 9.15. Sell 100 euro-dollar future contracts at 92.70, reflecting the 7.3 yield. December 20, pay interest 1.75 is now at 7.8. Borrow 100 million for 3 months at 7.8. Offset 100 December euro-dollar futures at 9.2, reflecting the 7.8 yield. Produces profits of 125,050 basis points. March 20, pay interest of 1.9 million and repay principal 100 million. This is just a brief introduction to stripped and stacked hedges. It didn't go in too terribly far in terms of explaining this. The next session, we'll dig a little deeper into strips, and then after that, stacked hedges. A lot of moving parts, as I mentioned. When you're playing with fixed income, there are a lot of things going on. And that's why fixed income people are fixed income. They have a mindset, they can visualize this information, and they can make split-second decisions. If you're comfortable with this information and you can see it backwards and forwards without a lot of thought, in other words, you can just visualize this, you can see it, then maybe you're a fixed income expert in the works. As I continue to state over and over and over, reread this. Rereading it only covers about 20% of what you need to do. Crunch the numbers, work at it, practice, practice, practice. Brad Williams, Frugal Finance. Thanks for watching.